Hi, class. Today's discussion is bonds payable, always an intimidating subject for many accounting students. However, it does not have to be. And hopefully, I'll try to simplify it here for you. With this lecture, we'll work 5 different bonds payable problems together as part of this lecture. As always, this video lecture should supplement your reading of the textbook. So if you read the textbook first, or if you go through this and you don't understand it, stop the video, go read the textbook, and then come back into this. Now, what are bonds? So bonds are a public document. Companies sell bonds to the public, and it's a form of debt, longer term debt. And so each bond will have a face value, an amount that they will pay back in the future, and an interest rate that they will pay along the way. And so bonds are publicly traded. Buy and sell bonds, and large corporations sell a lot of bonds. I think Apple issued billions of dollars of bonds over the last few years with low interest rates. Netflix, it seems like every time I turn around, they're issuing a $1 billion bond. Why is that? Why does Netflix, why are they issuing all these bonds? Well, we're all paying what, I don't know what it is these days, $9.99 a month to subscribe to Netflix. But when they run out of good movies, good series, we're going to stop paying that $9.99 a month. So Netflix always needs a lot of cash to produce some of these shows. Could cost $100 or $200 million, especially if they're going to have good actors and actresses. So they need a lot of upfront money to continue to propel their business forward. And to continue to get us to subscribe to and pay the monthly charges. And so bonds is a primary way that Netflix capitalizes, supports their operations. Now, for bonds, the bondholder gets no skin in the game. They don't get any percent of the earnings. They just get paid interest. And so with bonds, all companies have to do, pay the bond back and pay interest along the way. And then everything's good. All the leftover money goes to shareholders, to owners of the business. So if you have a good cash flow with your business, it's kind of good to leverage that debt, and especially in this low interest rate environment, and have more earnings left over for shareholders. So that's probably a pretty good thing. So now bondholders, again, as I said, can be intimidating for students, does not to be. And so let's just get into this. And for any of you who are finance majors, this should be a piece of cake for you. This is what finance is all about. So with that, I'm going to share my screen, and we're going to start looking at bonds. We don't need that. Here you go. Bonds payable. So every bond is going to have the face value, and that's the amount of cash that will be paid back on the very last day of the bond. Let me, I'll let you guys see me a little bit better here along the way. All right. So the face value of the bond is just, if it's a $1,000 bond, all that means on the very last day of the bond term, which we'll get to in a minute, the maturity date, that money will be paid back to the investor who gave the company money and bought that bond. And so that's just now with bonds, there's a lot of interchangeable terms. You might as well just start memorizing them right now. They make sense. They're pretty straightforward, but again, for all of us, even me, it's interchangeable in how I use these terms. So face value means the same thing as the par value of the bond, the principal of the bond, the stated amount of the bond, or the maturity value. I think mostly you'll see principal and maturity value and face value a lot as the more common terms. Now, bonds will also pay an interest rate along the way, and that's also, it's called the coupon rate. or the stated rate. So similar to the face value on the piece of paper, the bond piece of paper, it will have the face value of that bond, and it will have the stated interest rate. So that's why it's called stated, because it is listed on the bond. Also called the contract rate or the nominal rate. Now, there are going to be two interest rates here, which is where it gets confusing. This interest rate is a contractual rate of how much the company will pay. That coupon rate or stated rate times the face value, that's the amount of interest the company will pay. That's it. And they will never pay more, or they'll never pay less. We're going to see there's also a market rate, which is a different rate that could be higher or lower. You know, don't be confused by that. The stated rate, the coupon rate, the contract rate, that's the exact amount of cash that the company will pay over the life of that bond. Term, that's just the number of the years that the bond will be outstanding. So if you have a $1,000 5% bond, 5% 5-year bond, there you go. That's the term there. And so you'll see that term is also listed on the bond piece of paper. And finally, payments per year. Most corporate bonds are semi-annual, means they pay every 6 months. And so if they're semi-annual, they pay every 6 months. Keep in mind that the coupon rate, the stated rate, that's always a 12-month rate. So that payment, if there's 2 payments per year, they will pay half of that rate, and they'll pay it twice per year. Obviously, for the full year, they will pay the annual interest rate times the face value for the full year. But they might make it in more than 1 payment. There may be 2 payments. They could be monthly or quarterly. Generally speaking, though, all bonds, even U.S. Treasuries, they pay every 6 months, semi-annual payments. And so everything we've talked about here, face value, coupon rate, term, payments per year, that's all visible on the actual bond. That's really a piece of paper, but you know, I don't keep the piece of paper for the bonds that I invest in. My broker has those, and it's all electronic these days. But I'd like you to kind of imagine a piece of paper that is a bond. And it will have the face value, the coupon rate, the term, the payments per year, and payments per year. It will have all of these items listed on the bond. That is basically the company's promise that when you buy this bond, this is what we are going to do. This is how we're going to perform against that bond. You know, again, 2 biggies. I'm going to pay you back the principal, the stated value on the maturity date, and I'm going to pay you stated interest rates along the way based on the number of payments per year that is listed on that bond piece of paper. Now, here's the issue. Bonds are sold. Sometimes we say we issue bonds, but you know, the company issued bonds. We use the word issue a lot. However, it's nothing more than the company is selling that piece of paper to investors who are giving them money for that piece of paper. And that's how companies fund themselves. Now, here's the issue. There may be investors may expect a higher or lower rate than the company is actually paying in the stated rate. And if the company's paying less, then the company's coupon rate is less than what investors want and expect from the company based on the company's risk, then that company is not going to sell at the face value. It's going to sell at less than the face value. It's going to sell at a discount. On the other hand, if the company's coupon rate is higher than the investor would be willing to take, that bond will sell at a higher price. So the bond's price is based on the yield, the interest rate required by the market, and in comparison to the coupon rate. And so again, if that confuses you, you know, we're going to work a lot of problems here. We're going to see this in action. I want you to get back into the textbook and make sure you understand the dynamics of the price of the bond. And we'll look at it again in a minute. Now, the yield, that market rate, it also has a different names. It's called the market interest rate, the effective interest rate, or the yield. There are three different terms for the market rate. But think market rate, what the investor expects given the company. Now, let's look at a bond price here for a minute. Let's just say we had, just to make it easy, yeah, I'm gonna do just a 3-year bond. And so we have a 3-year bond, and let's call it $100,000 5-year bond. So let's see if I can do, there's 3 years, but guess what? It's gonna be paid semi-annually. And let's say it's a $100,000 bond, 5% interest or coupon rate, and three-year bond. Now let's do something here. This is not going to work. You don't need to see my face anyway. All right. So what's going to happen here, and this is the investor is going to give the company cash, and so this is the price right here. How much is the company going to pay? What's the company? How much is the company going to receive? The investor will pay it. But here, let's look at the streams. At the end of 3 years, the company is going to pay $100,000. Let's do this from the company's viewpoint. Now, along the way, every year, there's going to get 5% interest times 100,000, 5,000 per year. However, they're going to pay it semi-annually. So every 6 months, so there you go. Every 6 months. So this is what the cash flow stream looks like. The company is going to pay out $2,500 in interest 6 times, because it's a 3-year bond times 2, 6 times. So 2,500, 5% times 100,000 divided by 2. So this is what the company's promise is. At the end of the 3 years, we're going to pay you $100,000, Mr. or Mrs. Investor. And along the way, we're going to pay you 6 $2,500 payments. Now, if the market rate was 5%, oh, we're all good. Here, I will give you $100,000 for that because you're paying me the 5% I expected. However, what if the market rate, just make one up here, let's say the market rate equals, let's just make it 7%. I have it prepared ahead of time, so hopefully these numbers will work out okay here. So how are we going to price this bond so that the investor will earn 7%? Well, that's pretty easy because you understand time value of money. All we need to do is take these future cash flow streams and look at the present value of all of those at 7%. And then if the investor pays that amount up front, the present value of all that at 7%, then the market is going to really have an effective, a true interest rate of 7%. So let's go do that math. Let me bring my time value money calculator here. I love the HP. So what's the present value of 100,000 future value and compounding periods, 6 periods, interest rate is 7% divided by 2, 3.5%. What's the present value of 100,000? Let's get all that out. Make sure I'm not in begin mode here. And I've got 100, you can't see this, 100 100,000 as my future value, my interest rate 3.5%, my N equals 6, and there's no payments, and so my present value equals 81,350. I'm just going to check my math here because I didn't plan ahead on this earlier. So 100,000 future value, N equals 6, interest rate 3.5%, payment 0, present value 81,350. Like you, I make mistakes. It's a good thing to do on your exam to check this out. Now we also need, the investor's also going to receive an annuity. It looks like an annuity stream, right? $2,500 in payment. Also N equals 6. And I equals 3.5%. So what's the present value of that future stream? Let's clear everything out. Okay, we're ready to go. $2,500 payment, N equals 6, interest rate equals 3.5, 13,321. So that $100,000 that the company is going to give the investor at the end of 6 compounding periods is worth $81,350 at the market rate of 7%. And if I take 6 annuity stream of $2,500 payments at an annual interest rate of 7%, those are worth $13,321. Therefore, the investor is willing to pay $81,350 plus $13,321, sum of 1 equals $94,671. And so this becomes now a 7% bond, yielding bond. The investor is going to earn 7% by giving the company $94,671, and then later receiving $2,500 in payments every 6 months and $100,000 at the end. Now, this is priced at less than $100,000 because the company is only paying 5% interest versus a 7% bond. Now, one thing we do here is we say, what's the price of that bond? We use a percentage, and so this bond would be priced at 94.671. That's how we would list the price as a percent. Sometimes you'll see bond price 101. That means 101% of what? The face value. All right, so there we just calculated the price of a $100,000 bond with 5% interest, 3-year bond at market rate equals 7%. So we're paying less than the market rate, we get less upfront. Now, what I'm going to have you do here is, well, you don't know how to do this yet. I've got to talk one more thing here, and then let's get into interest expense. And maybe I almost just have to work this for you to see how this works. So let's look at the journal entries around bonds. By the way, everything here is on this page. So if you're in my class, you get this page when we talk bonds payable. I will pass it out to you in class. So the first thing we're going to do is debit cash for the money received and credit bonds payable for the face value. And then if the company is selling for less than the face value, we're going to debit a bond discount account for that difference between the face value and the price of the bond. If the bond is selling for more than the face value at a premium, then we're going to credit a bond premium. So this is entry number 1 that you need to know. And here's the how we determine the bond price, and this is everything we just did, so you know that. And then we're going to have to go calculate the interest expense for the bond after the first payment, and we debit interest expense for the carrying value, which is the bond face value minus the discount or the face value plus the premium. That's called the carrying value times the effective interest rate. And that becomes the yield. We credit cash for the payment, and then we're going to amortize this bond premium or discount. Now, let's go look at an example here. And so we'll start here, 14-1. We're going to do 5 of these. And so I'll kind of, you can still pause the video and try to price this bond out if you like. That would be a really good thing for you to do. So feel free, pause this video, see if you can determine the price of this bond. All right, hopefully you're back now. And so let's look at here. I'm going to use this today a lot, this template. Face value equals 100,000 on this bond. Coupon rate, that's the stated rate. That's the amount we're going to pay. That is 5%. Term equals 5 years. And market rate equals 6%. Now, this is going to be paid let me bring this up a little bit there to make sure you can see all of this. Let's do this, come over a little bit here. All right, here we go. Sorry about that. All right, now we're looking pretty. I'll try to remember that position there. So, all right. So what's the price of this bond? So the price is going to equal present value of $100,000 future value. How many periods? It's going to be 5 times 2 equals 10. What's the interest rate? We're going to use the market rate when we price the bond. The market rate of the bond determines the market price of the bond. That does make sense, I hope, to you. Now, it's an annual rate of 6% divided by 2 equals 3%, because this is a semi-annual. We're paying this twice a year. You can see June 30th, December 30th, June 30th, December 30th. So this paid semi-annually. So we're going to do that calculation. And it's also the present value of how many payments. The coupon rate is 5% times 100,000. So 5,000 divided by 2 equal 2,500. How many payments are there? 5 times 2, 10. Interest rate, 6% market rate divided by 2, 3%. And so 1, 2, and then 1 plus 2 equals the price of the bond. All right, let's get the old calculator out. Okay, $100,000 future value. Compounding periods equal N. Interest rate equals 3. Present value 74,409. And then let's do the next one. An annuity, $2,500 payment. N equals 10 still. Interest equals 3. Interest, and this is 21,325. So it's nothing more than just a simple time value of money calculation. Present value of that 100,000 at the end of 5 years at 3%. and 10 compounding periods, present value of the annuity, of an ordinary annuity, 2,500, n equals 10, I equals 3. And so we add these two together, and we're going to get 95,734. There's a rounding piece there that I know about because I've done this already. If we carried it out to the next decimal, and don't worry about rounding on the exam. So what are we going to do with that first entry? We're going to debit cash for 95,735, and we're going to credit our bond payable. So I'm going to start here. This is what I call amortization table. And so we have a debit to cash of only 95,735, credit to bond payable account. That difference we put in the bond discount account, 4,265. What's the carrying value of that? That's the bond payable minus the discount. So the carrying value is 95,735. Let's go forward to the first interest expense. The interest expense, we're going to use the market rate again, and we're going to take 3% because it's only a half, 6 months only. It's 5%. It's a 6% annual rate. This will really be easy to miss on the exam, even if you understand it. You'll miss this, so don't do it. So I'm going to take the annual rate divided by 2, 3% times 95,735. And so my interest expense is 2,872. How much did I pay? Well, we already know that. We calculated that out. We're going to pay, that's $2,500. That's what we promised to pay. That's what the stated rate on the bond says. I'm going to pay you 5% a year of the face value, 100,000, 5,000, 2 payments per year, 5,000 divided by 2, 2,500. So I'm going to pay 2,500. But our real interest expense is 2,872. You know what? That's because we only received $95,000 up front. And then later as a company, we're going to pay $100,000. So this discount of 4,265 is kind of a true up. That represents interest over the whole 5 years. Therefore, in accounting, we're on accrual-based accounting, we've got to recognize that additional interest. And we're going to amortize the bond discount, and that's just the difference between 2,872 and 2,500, 372. So if we think about this entry here, if you just bear with me for a minute, debit interest expense, 2,872, credit the interest payment for 2,500, credit the bond discount account for 372. That's our entry right there. So step one, if you're thinking about this formulaically, calculate the interest expense. Carrying value times the market rate, which is 6%, but it's divided by 2, 3%. That is the interest expense. What is the payment? That's the stated rate of 5% times the face value, 100,000, times 5%, 5,000, but 2 payments per year, 2,500. So this is, and then this is just the difference between the two. Now that we've credited the bond discount account, we debited expense, we credited that account, the balance isn't 4,265 anymore. That was a debit balance. Now it's going to be reduced by 372 down to 3,893. We don't touch the bond payable account to the last day when we pay it off. So we have a new carrying value now. What's the new carrying value? Bond payable account minus the bond discount account, 3,893, 96,107. Here we go. Maybe if now you've got it, you didn't get it before, pause the video, calculate the next line item. Pause the video, calculate that next line item. All right, hopefully you were able to get it now. So I'm going to take 96,107, step one, times my interest rate, 3%, and my number is going to be 2,883. How much do I pay? I always pay 2,500. That's what we pay. Now I got my difference here, 2,883 minus 2,500. That difference is 383. And so if you think about the journal entry here, debit interest expense, 2,883, credit cash for 2,500, and then credit my bond discount account. We're reducing it. Start out with a debit balance. We're reducing it by the difference between item 1 interest expense and item 2 interest payment. So now we reduce the 3,893 with a debit of 383, a credit of 383. Now we're at 3,510. Bonds payable account, 100,000. What's my carrying value? 100,000 in a bonds payable account minus the debit. This is a credit balance minus a debit of 3,510. I'm at 96,490. See how this thing is growing? What it means, we're gonna amortize this down until it's gonna end at 0, ultimately at 0. This will end at 100,000, and the carrying value will be 100,000. That's the very last stage of this, and because we're taking this represents, this debit represented interest expense that we're going to expense a bit of it over time. And we're truing up the difference between the 5% we're paying versus the 6% yield. Pause the video again, do the next line item. Get good at this, practice it. All right. Step 1, interest expense. 3% yield for half a year times 96,490. And this is going to be equal to 2,895. So that's my debit to interest expense. How much am I paying? Step 2? Well, 2,500. That's easy. That's 5% times the face value divided by 2, 2,500. All right. How much is my amortization? It's 395. What's my new balance in the bond discount account? It's 3,510. I'm now going to be 3,510 debit minus the credit of 395, and now equals 3,115. 100,000. New carrying value of 96,885. Now, here's what I'd like you to do. You really want to learn this. Pause the video right now and then finish out this entire chart. Finish this whole chart. It won't take you that long. Pause the video, do that, and we'll come back and we'll look at the chart. All right. Guess what? Beautiful handwriting. I'm going to use my Excel spreadsheet here. Right here. There is the entire answer that you should have seen, and I'll let you take a look at that. You can see that this balance starts out with a debit of 4265. You think about the bond discount account, it started out with a debit of 4265, and all we're doing is debits all the way through, all the way down until this ends up at 0. And that amount represents interest. Why? Because the company only received 95,735, but later they have to pay 100,000. That difference that they're paying more is a true up. Why? What's it a true up? They're only paying 5%, but the market wants 6%. So they have to true that up. They have to make up that difference between 5% and 6%, or they will just never sell this bond. All right. We got a lot of these. So, before you get too bored, let me pull up the next one. Now I got to find all this stuff here. I should be more organized, I guess. Exercise 14.2. So pause the video. I want you to work out the price on that. And then see if you can start the amortization table as well. Step one, get that price. Well, fortunately, this is only a 3-year table, so that makes it a little bit easier. I still use the same template on that. And so what do we have here? We have face value equals 500,000. Coupon rate or stated rate, 12%. Sounds good, 12%. Term, 10-year treasuries right now are at 0.5% or something crazy like that. And then the yield or the market rate is 10%. So look at this, the company is paying more than the market rate. And so guess what? They're going to sell it for more than the face value. It just makes sense. They're going to pay 12% interest along the way over the 3 years. Therefore, they got to get more upfront. That's the way it works. Payments, semi-annual. All right. Let's take a look at this. Let's go determine the price again. Present value of 500,000, future value at N equals 3 years times 2 payments a year, 6, and and now we're going to use the yield equal 10% divided by 2 equals 5%. So that's easy. And then we got a present value of an ordinary annuity. How much are the payments per year? Well, that's the coupon rate. So that's going to be present value of 500,000 times 12% divided by 2. And I can do that in my own head, 30,000. Could that be 60,000 a year at 12%, 2 payments per year, 30,000. Hey, N still equals 6 and I equals 5%. That doesn't change. And we need the present value of that. All right. Here we go. Turn it on. Hopefully you guys knew how to use your time value of money calculators here. Let's see if I put it up closer to clear everything out. 500,000 future value. N equals 6. Interest rate equals 5. And look how easy this. Present value, 373,108. And that's not the only thing we're getting as in paying, I guess, as the company side. We're also going to be paying 6 payments of $30,000 over the next 3 years, 2 payments a year. And so what's the present value of that ordinary annuity? We're going to take 30,000 equals payment, PMT. N equals 6. I equals 5%. Present value 152,270. 1 plus 2 equals 373 plus 152, 373, 108, 525, 378. There you go. You remember from principles of accounting, the price of the bond was given to you. Here, you're calculating it. That's pretty cool. And so let's go do the bond amortization table. And as we're doing this, I want you to think journal entries here, right? Because the first thing we're going to do, we're going to debit cash for 525,378, and we're going to credit the bond payable account. The only thing that goes in the bond payable account is the face value. We never change that. But now we have a premium. What balance is a premium? It's a credit balance, 25,378. If you think about it, we debit cash for 525,378. We credit the bond payable for 500,000. We credit the bond premium account for 25,378. What's it going to be at the end of 3 years? 1, 2, 3. It's going to be 0. And we're going to amortize that down. So if it starts with a credit, how do we amortize it? With debits. Okay. All right. What's the bond carrying value? Well, this time we have 2 credits. So it's 500,000 plus a credit of 25,378. So 525,378. If you haven't already done it already, you could pause the video and try to do this first line. And maybe even do the journal entry if you can think through that. All right. Step 1, what is interest expense? Always, it's the yield. And is it 10%? No, because it's only 6 months. So it's going to be 5%. So 5% times 525,378 equals 26,269. How much are we paying? Well, we're paying 500,000 times 12%, 60,000, but divide by 2 because 2 payments a year, 30,000. So we're going to credit cash for 30,000, debit interest expense for 26,269. We still have another debit remaining. It's just 30,000 minus 26,269, or 3,731. Okay, start with a credit balance of 25,378 minus a debit of 3731. I have a new balance, 21,647. My bonds payable account still has 500,000. That doesn't change. It's credit balance. What's my new carrying value? 521,647, and that's just bonds payable account. In this case, plus a premium. It would be minus a discount because the bond discount has a debit balance. This has a credit balance. Now, go do the rest of this chart. Pause the video, do the rest of this chart for me. And if you do this, practice this, it's going to become like second nature to you. And here you go. Here is the answer. And you can just see each, we make 6 $30,000 payments. And we calculate the interest expense that is market rate 10% divided by 2, 5% times the carrying value. And that's true for every one of these. That's going to be 5% times the carrying value, 5% times the carrying value. And look how it all works out. The difference between the cash payment and the interest expense, that's the how much we're amortizing the bond premium. And by magic, it works out to 0 every year. That's just how the math works in this kind of arrangement. So again, entry, let's just do the entry. Entry 1 on 12/31, that was debit cash, 525,378, and credit bond payable. We always put just the face value in the bond payable account, 500,000, and credit the bond premium for 25,378. And if we tried to squeeze in, I'm going to erase this here. Let's just do the journal entry number 1. Let's do the June 30th journal entry. That's going to be debit interest expense for 26,269, and then we're going to debit the bond premium account 3,731, and credit cash 30,000. All right. So hopefully I'm setting you up for the next problem, which I've got to go find now. Here you go. Instead of doing an entire amortization, this one now, I mean, clearly you guys should be able to do this. I want you to go do this for me right now. Honestly, pause the video and work this problem. You don't have to do the whole amortization. Calculate the price of the bond, complete the journal entry for the bond issue date and for the first payment. And then look at how much interest expense was for the first year of the bond. All right, are you guys back with me? This could be just very similar to how your test might appear, by the way. So let's go take a look at this. Face value or maturity value or par value. Don't forget the other terms that could be used for this. 500,000 and coupon rate 8%. Term 3 years. Yield or market rate or effective rate, all mean the same thing, is 10%. And then paid semi-annually. All right off the bat. Investors are expecting 10%. We're short paying them. We're only paying them 8%. We're not going to get 500,000. That just makes common sense. They're going to pay us less than that. How much? Let's discount it back at the yield. Present value of $500,000 future value at N equal 3 times 2 equals 6, and I equals annual rate 10% divided by 2, 5%. Pretty easy. And then present value of an ordinary annuity for payment equals 500,000 times 8%, 40,000 divided by 2, 20,000, and equals 6, I equals 5%. So pretty easy stuff here. You guys should be getting really good at this. All right. 500,000 future value N equals 6, I equals 5, present value 373. Let's just do 1 and 2. 108 and 2. Payment equals 20,000. N equals 6 again. I equals 5. Oh, I screwed that up. I'm going too fast for my own good here. $20,000 payment. N equals 6. I equals 5. Present value 101,514. 1 plus 2, 373 plus 101,514, 474, 622. Entry 1. I didn't put a date there. Let's just do 1/1, whatever year that is. Debit cash for the price. That's how much you're going to receive. 474, 622. Debit the bond discount account for the difference because we're credit bond payable for 500,000. The difference, that's going to be 25,378. All right. And then first entry, make it 630. After 6 months, we're gonna pay. So you can save time not having to do the whole table now. How much cash are we gonna pay? Credit cash. It's gonna be the bonds payable 500,000 times the coupon rate, 500,000 times 8%. That equals 40,000. But we're doing 2 payments a year. So 40,000 divided by 2, credit cash for 20,000. Debit interest expense, that's going to be the carrying value, 474,622 times the yield, the market rate, 10%, but divide by 2 because this is 2 per year, 5%. So 474,622 times 5% equals 23,731. All right, now I got to credit my bond discount account for the difference, 3,731. Hope you guys are following this. If you don't understand, this comes from how much we're paying. How much we're paying, that's going to be the coupon rate times the face value, 40,000, but 2 payments per year. So we'll make 2 payments of 20,000 to get to that 40,000 we own. Interest expense, that's the real interest expense, and that's going to be the yield of 10% divided by 2, 5%, times the carrying value. What's the carrying value? Bonds payable minus the bond discount, which was at 474,622. New carrying value. It equals 500,000 minus the bond discount account, and that's going to be the 474. 25,378 minus the credit we just put there, 3,731. So new carrying value is going to be 500,000 minus the new balance in the bond discount account, 25,378, 21,647. $478,353, and I'm trying to calculate. I'm trying to answer the problem just so you know what I'm trying to do here. I'm going to take a step back. How much interest expense did the company incur in the first year of the bond? We've already got the first 6 months interest expense right here. I'm going to calculate the second 6 months, and that is interest expense for second 6 months equals 478,353 times the yield divided by 2, 5%, equals 23,918. So just make sure I got that right. 23,918. So to answer that next question, interest expense is going to be 23,918 plus 23,731 equals, I'll just do it, 23,731 plus 23,918 equals 47,649. Again, that's how I just answered this entire problem. I'm going to give you one more, and then we'll call it a day because it's getting to be a pretty long video here. the exercise 14-4. Here you go. Pause the video, and then we'll go work this one. Okay, so the price of the bond is going to be present value at yield of 4%, paid semi-annually, so paid at 2% interest rate, and N is going to be 3 times 2. There's going to be 6 payments. And it's also the present value of an ordinary annuity. The payments, that's determined by the coupon rate, 3% times $1,000,000, $30,000, but divided by 2, 15,000. Still, I equals 2%, N equals 6. And if you do all of that, you are going to get to an answer of 971, 993. I'm just going to check my math here to make sure I didn't screw that up, because God forbid I'd have to redo this entire video because I screwed this up. So we'll do $1 million and the future value, and I've got payments of 15,000. Interest rate equals 2, is at the yield, and term equal payments equals 6. Present value 971, 993. Okay, there you go. So that is correct. So I already had this out. So what's the first entry again? Debit cash for the price of the bond. That's how much we're going to receive. We can't sell it for $1 more or less than the price, which is based on all that present value calculation. And we're going to credit the bond payable account for the face value, $1 million. And therefore, now we have a discount. The difference, 28,007, and that's just $1 million minus the cash we received for the price, and that's going to be in the bond discount account. Entry number 2, debit interest expense, and that's just interest expense is the 2%, 4% divided by 2 times the carrying value, 971, 993, 19,440. How much cash we're going to pay out? Credit cash. That's the stated rate, 3%, times the face value, $1,030,000 per year, 2 payments per year. Debit cash for 15,000, and we're going to credit the bond discount for 4,440. There you go. If we do that entry again, the next interest expense is going to be 19,529, and we would add those two together to get the interest expense for the year, 19,440 plus 19,529 for first year equals 38,969. So this is a very long video. I hope that you were hanging with me. Keep in mind always that the cash we're going to pay out, That is determined by the coupon rate, the stated rate. Here it is, 3%. The interest expense is determined by the yield, the market rate, the effective rate. If you keep those two kind of things in line, I think everything else will kind of fall in place for you here. If the bond sells at a discount, we record the difference that between what we received on the discounted price in a bond discount account, and then we amortize that with credits until it goes to zero. If we receive more cash because we're paying more interest rate than the market rate, then we're going to credit the bond discount account and for the difference between the bond payable and the additional money we receive, and then we'll debit those bond premiums. So it's just like a mirror image of this bond discount problem. Okay, guys, again, I know it can be intimidating. There's a lot of moving parts here. That's why I think practice makes perfect here. Go back, continue to work these problems, and you can get back, you speed the video backwards and look at the problem again, try to work it on your own, and then come back and watch how I worked it. So thank you for being engaged in this video, and wish you the best of luck on bonds payable. Thank you.